Michael Lydick, Back to the Future. Michael, how are you?
Man, I'm better than I deserve to be. I hope everyone at home is well today. You too.
Michael, let's get to business here. And I'm hoping we could take a look at gold first, because that's top of mind for me, right? What are you thinking?
Gold, please.
Gold, please. Sure. So we had a short this morning in gold. If your viewers remember, the premise of what we do is sort of based on this idea of predictability. There's two schools of thought when it comes to market trading. You sort of have school number A, people who believe that we're all sort of reacting in unison to all the available information, right? We're watching all the reports, all the incoming news. They discover a way to harvest gold from a comet that's going to pass by, which will seriously depreciate the prices. We're all sort of watching and making a unified decision on the value of something. We sort of go in a different direction and say the people who have the most power, the most money, the most control generally don't leave things to chance. And so we want to follow them and see, are there any patterns based on time where people are doing things relatively consistently? So this morning at 10 a.m. before the show came on, I know you guys look at precious metals and energies a lot. So I pulled up my chart and saw that there was a predictive sell signal at 10 o'clock this morning until 11 o'clock this morning. And what this is sort of that old World War II radar. You see the submarine, and they're sort of looking for these other submarines or ships in the area. That signal is sort of warning us, just like the MNQ short we took this morning at 1029. There's a behavior pattern that shouldn't exist, but it's there. And for one reason or another at 1029, historically, lately, the market drops. And I noticed you had a 10-minute chart up there earlier. We had a similar signal here. We had a long signal from 10 a.m. until 1020, and then the 1020 high where it dropped was basically another one of those anomalies when the software was asked to look for a time-based target. It said, hey, for one reason or another, lately at 1020, the people that we believe in drop the prices now until 110.
So, Michael, real quick, when you have a signal from 10 to 1020, does that tell you, hey, this is a time frame in which you should get in, or does this tell you this is a time frame in which this trend should expire?
What it's telling you is that if you believe there are people who push prices at certain times that don't leave things to chance, there's evidence of that. There's a recurring time-based pattern that normally appears between 10 o'clock and 1020. And so this is telling me if I'm watching on a 10-minute chart, over the last several weeks at this time, there's a historically relevant move that is repeating. We're not hardwired to look for those patterns. I think it's one of our biggest deficiencies. Like, a lot of people are using AI now to sort of help augment their jobs and stay on top of their appointments and things like that. It sort of fills in those gaps we have as humans. We have gaps, right? We're emotional, reactive creatures. They did a study actually at Northwestern, and they call it the recency effect. We pay the most attention to the things that are happening in the last few minutes of our lives. We all have a friend who gets involved in a relationship and we go, yup, that's his type. They're going to break up in 4 hours because we don't pay attention to those patterns, right? Well, this software is saying, hey, dummy, over the last few weeks, the cabal, or whoever you believe those people are, JP Morgan's getting ready to unleash hell at 1020. And if you want, maybe you should risk a few nickels to see if you can make $1. So if you translate that over to gold, on the lower time frames, we can see that pattern exists. But let's go ahead and turn the chart trader off for a minute. And I'm assuming when you're looking at large targets, we want to kind of zoom out to a larger time frame. Right now, if we apply that same methodology to gold on a larger time frame, we're basically using a larger sonar signal, right? Instead of looking for small ships, now we're looking for aircraft carriers. Are there any seasonal patterns we should be aware of? You had mentioned how far should it go. We're talking about exertion or extension versus time. So time, if we're looking for those patterns, gives us direction at a specific time, or in this case, date. And the last signal that we had was on October 15th. So again, we got a hit. So if I was down in the belly of the submarine with Sean Connery, right, I would say,
sir, we've located a temporal anomaly.
Well, how long will the signal last, young man?
It will last until November 5th, sir.
Carry on.
And so we've got this window now that extends until November 5th. Now, you had mentioned earlier, hope is not a plan, right? Hope is this really effusive word in trading where people apply these loosely worded, discretion-laden phrases and sort of roll the dice. Well, the program is telling us, hey, there's a seasonal pattern from October 15th to November 5th. It's there, and it's sort of very black and white and discretion free. Now, in relation to your question, where's it going to go? We can look at exertion. Exertion is basically the distance. So if you pretend JP Morgan is maybe behind this, we kind of ask the question, how far do they move when they move? When we were kids in gym class, remember they used to make us go out and run around the field, which is usually when the coaches were phoning in their bets on the next football game.
And they made us wear these ridiculously uncomfortable shorts.
You got all sweaty right before the class with the girl you like, but you inevitably had three groups of kids. You had the fast kids, right, who would go on to be on track teams. Then you had most of the kids who were fit and in shape and they were okay. And then you had kids like me that were just praying to whatever God that would listen back for this horrendous activity to end. So you had these three levels of exertion. Really fit people, average people, not so fit people. Well, when we look back, we're kind of looking at the evidence of when those signals occurred, how far did JP Morgan move when they could move? So we'll look at from the lows of these candles as far as it went by the next sell signal. Now we sort of harvest those arrows like blueberries, and we come over and we say, all right, where are the fat kids, where are the skinny kids, and where are the average kids? And we've got these neat three levels when we're looking at exertions now, and we can make some conclusions. JP Morgan, at the bare minimum, we were expecting them to go from 26.54 to around 27.35. And now we sort of have the fit kids in the middle. We're expecting them to kind of come here maximally to 7.53. If everybody ate their Wheaties that morning, we're looking at a maximum capacity here of 27.81. And then we really don't have much in the way of rights to expect more out of it, because when the coach asked the kids to run around the field, that's as far as they got in that window of time. The neat part of time versus exertion is we can get a sense of how far markets move when the people we believe exist move those markets. Like right now on the MNQ, we're coming into that 1048 signal. I don't have much more time here. I've got a minute and 30 seconds until 1048. So that move here would be an outlier. That's not about as far as the market has been moving when it's dropped lately. So the outlier for gold on the upside is going to be around 27.82. If you like round numbers, 27.80 or 27.85 would be a good place to watch for that.
I got it. Now, sometimes, though, we know seasonal patterns don't repeat.
Sure. You mentioned that earlier when you were talking about trading systems in general. If you're constrained inside of a rules-based trading system, and your listeners usually fall into one of three groups. You have trend traders, you have mean reversion traders, people who are looking for tops and bottoms, and then you have a consortium of different things like support and resistance, market delta, TPO charts, a lot of smaller, lesser used systems. Well, a trend trading system on average is somewhere between 50 to 55% expectancy with a profit factor between 1.5 and 2. If you're trading a mean reversion system, you're kind of in that 60 to 70% range with a profit factor somewhere around 1 to 1. When we're following a trend trading system like normally with gold, you're going to see about 50 to 55% of the trades are profitable. But because you're following the trend, your winners are much larger than your losses. For example, on this MNQ chart right now, I'm really hesitant. If I was going to buy this, I'm going to put my stop right underneath it because I don't like to play the counter trend game. I think that for me, I've seen most people lose the most money trying to pick highs and lows and reversals. So I tend to lean more towards trend signals in terms of picking a ride with a truck that's already moving in that direction, if that makes sense.
Yeah, and do you find this type of analysis, it's stronger in one stock index future versus another?
No, it's a common misconception. I look at it in terms of if a handful of funds and institutions own the majority of equity in the world, right? And that's not a conspiracy. That's a verifiable fact. You can look at the data sheets and see what does BlackRock own? What does Vanguard own? What is JP doing? They're consistently not leaving things to chance. In fact, when you were talking about gold, one of the things that's interesting to me, JP Morgan, they were recently fined $1 billion to stay with me.
That sounds like a big number.
It isn't for them. JP Morgan basically got in trouble for spoofing with gold futures. And essentially, they made orders appear on the ticket, the dome, that weren't there. It was so prolific and so over the top that the government, basically CTFC, SEC, said, we've got to fine you a lot of money, cut it out. Well, if you go back and look at what they've done, you can actually look and see there's a website that will track all the fines JP Morgan pays.
What?
Well, JP Morgan Fine Tracker. We actually took a weekend and added all the numbers up. If you took for the last 5 years all the profits they've earned in relation to the fines they've paid for things that are pretty egregious, they make $3 for every $1 in violations. So if you think of that, if you stole 3 TVs from Best Buy or Walmart today and you had a JP Morgan shirt, the security guard would make you put one of them back and help you load the other 2 up in the truck. Like, that's a real thing.
This is like an ATM machine for the U.S. government.
It's an ATM machine for people in power. And so this morning, when we're looking at the E-mini S&P, for example, the program is basically set to look at the last 2 Mondays. NinjaTrader is so great for stuff like this because the platform affords us the opportunity to perform very intense database management calculations and ask hard questions. These aren't things your brain naturally thinks about and sees. So we're saying, hey, look at the last Monday and the Monday before that. Are there any times that we should be aware of where moves have happened relatively consistently? When you look at that, it means that the signals on this chart are 1 week old because the last piece of data was available at the close of business Monday. And it was essentially warning us that if the Wizard of Oz exists, if the boogeyman exists, these were the movements that they were likely to repeat. And so this morning on the ES, that's a $16 move. It's even further than that since we've been talking. And that move should last until 11:05. So there's this interesting thing that happens when you take this approach. When you're watching it intraday on all the instruments, you see that it kind of falls in a 60 to 70% window of, ooh, the thing I was expecting happened. So when we extend that over to a daily chart, for example, on gold, or if we're looking at bonds, so this morning, the trend has been down in bonds. And so now with the approach that I take, I'm saying, hey, there's a tendency for it to go down from 245 until 510, from 550 until 635, 735 until 825, and then 950 until 1005. So I have these windows based on my belief that if whoever it is going to do it again, I want to be there with their 1,000 contracts, pushing me like a tsunami, like a piece of flotsam caught up in this massive river of orders. If they're manipulating the market and that's the way the markets really work, I want to be in that number when the Saints go marching in.
Okay, so going back to the intraday example where you take a look at the previous 2 Mondays, does the data change or get better if you go back and look at the previous 3 or the previous 4 or the previous 5?
That's actually a very common question, and it's helpful to think of it like a boxcar with a train. If you can imagine a train that has a bunch of cars attached to it, if you have sort of this locomotive, right, the common misconception is the more data that you have behind you, the better the accuracy. And what we find is that these patterns are more like sand dunes that are eroding and building over time. And so generally speaking, if you're looking intraday at a 2-week window, anything past that, the patterns have already changed or degraded. And so if you're looking much shorter than that, you'll get some interesting stuff too. But generally in a 2 to 3 week window, these patterns that were here are getting less and less important, or Jim, they're starting to move to the right or the left of that original time signal.
I would say that the paradigm of the market has slightly changed over that time period.
Oh, sure. Your success in markets is based almost entirely on this idea of neural plasticity. If you're trading with a 2-point stop and a 2-point target on the ES, like a lot of people were 10 years ago, you're stopped out on every trade because 8 ticks is nothing now in these markets. And the longer you trade, the more versed you are in different systems. We look at VWAP. I never used to look at VWAP. Hundreds of people are saying it's a test of the VWAP. I have to look at it because if everybody's looking at it at that point in time, it's almost a self-fulfilling prophecy.
I've said that at least 27 times so far this morning.
So in that sense, it stands to reason that here's a classic answer to your question. We were watching the clips from the Crying Game. And do you guys remember, you may not, there was a cryptograph, a machine that the Germans were using called Enigma. What Enigma was infamous for, what kept the Allies on their toes, it had this dial at the top. And so every week they were given the numbers to change all of the machines all over the front. Now it's 652, and 652 changed all of the cryptography for the messages going out. But everyone who had that typewriter would change their number to 652, and the messages made sense. So when you're looking for historical patterns in the data, keeping your window short can be advantageous. Let's look at an example of that. I actually think this is a great thing.
By the way, Benedict Cumberbatch did a movie.
Yeah, that's the clip we were talking about, the crying game.
Yeah.
Alan Turing, who's basically created the first computer, was laughed at by the intelligence agencies that were hiring the brightest minds of the world to go back and decode these ciphers. In this case, let's actually test your theory. We can come down to the software and say, hey, let's just look at the shortest possible window. So in that case, Jim, that would be looking at Friday. Let's look at what the people who move markets did on Friday, the times that the markets went up and down, and project that forward onto Monday. What you have here now is essentially a time map. And in this instance, the program is telling us, hey, the people who moved the NQ moved it up at 9:36, 9:51, 10:19, 10:37, 10:57, 12:10, 1:04, and we have the entirety of the session sitting here. And then conversely, the people who moved the markets on Friday, there were significant drops at 10:47, 10:31, 10:11, 9:46, and 9:19. And so that's the shortest window you can anticipate. If we wanted to, we could add a little more data to that and say, hey, what happened 1 day ago, 2 days ago, and 3 days ago? And now we have more of an aggregate, right? A composite's being built. And so if we bring a little more data on par with it, we're still not mad at the results that we're seeing so far. We've taught our customers the easier thing is to trade with trend. So we're watching from 9:36 to 9:46, 9:51 to 9:54, 10:06 to 10:11. And right here, you'll see the trend change. When those buy times first hit their stops, the program is basically saying, hey, this was a buying window, but nobody bought. There was a void. Like Air Jordans went on sale on eBay and nobody wanted them. Oh, I better sell all my Air Jordans right now because it's like the Beanie Baby movement. They're going to be worthless. Now I'm shorting from 1025 to 1029, 1031 to 1040, 1047 to 1052, and 1055 to 1103. So more data, less data depends on the personality of the user. We've been using these settings for 15 years.
So Michael, we're up against time, but go back to that chart. I got one more question for you really quick.
I love questions.
So in the example, the 10-11 example where the stop occurred, right? So we got stopped out. The Beanie Babies are just useless. Does that adjust the data going forward or no?
No, you're looking at the last 3 days. And so we're superimposing a belief. If JP Morgan or Deutsche Bank or Goldman Sachs are involved, there are procedures in their universe as a monolith, as a juggernaut. They just can't go long and short when they want. They're balancing funds, there's procedures and processes and things. And so we're sort of looking through the glass into their world, Jim, and saying, when do you do the things that you do? When do you balance your funds? When do you pay your profits out? When does the UPS driver arrive at JP Morgan? Does that affect things? And so there's no adjustment because with this, when you're trying to backtest, if everything is changing, disappearing, and reappearing, you have no foundation for the thing you said at the beginning, which was important, a rules-based trading system. If everything's disappearing, reappearing, changing, updating all the time, you're essentially in an emotional vacuum, a cycle where you're doomed to fail.
Makes perfect sense. Well, Michael, I'm glad you're safe in North Carolina. I appreciate your time with us this morning. It's been awesome and looking forward to having you back.
Absolutely. I love you guys.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.